Stop what you're doing. If you own any semiconductor stocks, you need to see this financial breakdown. What if I told you the absolute smartest play in the semiconductor space right now isn't fighting for supremacy at the 3 nanometer level? Seriously, what if the real gold mine is literally stepping off that bleeding edge battlefield entirely? Look, I know a common fear among retail investors is that in the chip market, anyone not named TSMC is basically a trap. You think if they aren't the biggest, they're destined to get crushed. But today, we're looking at a company that is actively proving that fear wrong. We're talking about GlobalFoundries, and they're executing a strategic pivot so wild, it's designed to bridge this company from a 29% gross margin today all the way to an incredible 45%. That is a massive structural shift in profitability. By the end of this explainer, you'll know exactly how they plan to pull off this multi-year margin expansion. Okay, let's dive into this.
Here's how we're going to break this all down today. First, we'll look at the current foundry market landscape. Then, we'll check out their Q1 2026 financial foundation. After that, we'll map out the path to those 40% margins. We'll follow that up with the silicon photonics catalyst, and finally, we'll look at rewarding the shareholders.
All right, Section 1, the foundry market landscape, the David versus Goliath dynamic.
So take a look at this market share breakdown from Counterpoint Research. Right at the top, you see TSMC. They are the undisputed Goliath in the room, commanding a massive 68% of the pure-play foundry market. I mean, they are dominating the advanced 3, 4, and 5 nanometer nodes, the stuff powering NVIDIA's AI GPUs and flagship smartphones. But then look further down. Down the list, we see GlobalFoundries. They hold a much smaller 4% share. But here's the thing, it is a highly specialized 4%. Because think about it, when you're up against a behemoth that essentially owns 70% of the market, trying to outspend them on leading-edge logic chips, that's just a losing battle. And that reality makes GlobalFoundries' highly profitable, specialized niche strategy absolutely crucial to not just surviving, but thriving.
Moving on to Section 2, the Q1 2026 financial foundation, a steady base for future growth.
So if we pull up their Q1 2026 earnings report, we can see that GlobalFoundries is actually starting from a really solid foundation. CEO Tim Breen reported revenue of over $1.6 billion and a non-IFRS net income of $227 million. Breen pointed out that they're seeing some serious traction in secular growth end markets, which really just proves their differentiated tech is already winning them market share. But out of that whole Q1 report, the most important number for our analysis today is this one, 29.0%. That right there is their current non-IFRS gross margin. I want you to mentally bookmark this 29% baseline, okay? Because it sets the entire stage for the massive multi-year jump in profitability that the executive team is currently targeting. Actually, before we even get to those future numbers, let's just pause on this one concept. It's not about being the biggest, it's about finding the most profitable niche. Literally, this is the central thesis of GlobalFoundries' entire business model. By actively avoiding that capital-intensive rat race of single-digit nanometer nodes, they're able to optimize their existing footprint for massive, massive profitability. Which brings us to Section 3, the path to 40% margins. Let's reverse engineer that margin bridge. Now, what's really interesting here is how specific the CFO was with this timeline. They aren't just guessing. They're aiming for an exit gross margin of about 30% by the end of 2026. Then they're projecting a huge leap to a 40% target by the end of 2028. And over the long term, they are eyeing a staggering 45% gross margin. You guys, going from 29% to 45% doesn't just improve the company. It fundamentally changes their entire financial profile. So, how exactly do they plan to get there? Well, the CFO outlined a roughly 10-point margin bridge driven by 4 main things. First up is a better product mix. They're seeing a huge shift toward high-growth, high-margin areas like communications infrastructure and data centers, which actually grew around 30% last year. Second is technology services. By expanding capabilities like risk-free through acquisitions like MIPS, they expect tech services to grow from around 8 to 10% of revenue all the way up to 12 to 14%. The third driver is just straight-up manufacturing efficiency. And fourth is better scale and utilization of the footprint they already have, meaning they don't have to build massive, expensive new modular expansions just to hit these targets. CFO Sam Franklin pretty much summed up the whole vibe perfectly when he said, GLF is on a path to propel durable growth, expanding profitability, and long-term shareholder value creation through the end of the decade. And look, this isn't just some hopeful projection. This is a super confident vision anchored in investments they've already made and customer design wins they've already locked in.
Let's look at Section 4, the silicon photonics catalyst, fueling the AI data center boom.
Okay, first, a really quick definition so we're all on the same page. Silicon photonics, and specifically co-packaged optics, or CPO, is essentially the science of bringing fiber optic connectivity directly closer to a chip. And this brilliantly illustrates why GlobalFoundries is in such a prime spot right now. Think about it. Modern AI architectures need to move massive amounts of data at lightning speeds, right? But they have to do it without literally melting down the data center. Silicon photonics makes that possible. It enables faster, higher bandwidth, and way more energy-efficient data transmission compared to your old-school electrical copper connections. GlobalFoundries hasn't just stumbled into this. They've invested over $1 billion in R&D over the last decade to build what they called their Scale platform. It's an ecosystem-based optical solution that actually exceeds current optical compute interconnect specs. They're rolling this whole thing out in 2 phases. Phase 1 is happening right now, heavily focused on pluggable optical transceivers, and they were really bolstered by their recent acquisition of Amphon. But Phase 2 is the big one. That's co-packaged optics, and management expects that to hit a huge inflection point right around late 2028 into 2029. And the demand from data center customers is so off the charts right now that GlobalFoundries is targeting a massive $1 billion run rate for silicon photonics alone by the end of 2028. $1 billion. And over the longer term, they're projecting that to double to a $2 billion target. They've even already recorded 2 tapeouts on their co-packaged optics solutions back in Q1. When you put this strategy side by side with the broader industry, the brilliance of this pivot just becomes so obvious. You have traditional foundries burning billions of dollars fighting that single-digit nanometer logic chip rat race. But GlobalFoundries, they are intentionally choosing to dominate high-margin specialty nodes. We're talking silicon photonics, radio frequency for satellite communications, and their AutoGrade 1 embedded magnetic RAM built on their ultra-low-power FDX platform for next-gen vehicles. To put it simply, they aren't fighting on 3 nanometers. They are choosing instead to own the AI connectivity backbone. Just like the CFO noted, their served available market can nearly double by the end of the decade using technologies greater than 10 nanometers. They absolutely do not need to be TSMC to be incredibly successful. Which leads us right into Section 5, rewarding the shareholders, the ultimate payoff. At their 2026 Investor Day, GlobalFoundries celebrated a pretty huge milestone. They officially announced their first ever quarterly dividend of 12 cents per share, which is payable in July of 2026. This is a massive, undeniable signal of confidence from the board of directors that their free cash flow is going to be highly durable moving forward. Right alongside that dividend, they unveiled a very systematic capital allocation framework. They're targeting returning up to 50% of their trailing 12-month free cash flow straight back to shareholders. This is going to happen through a combination of that new dividend and an aggressive share repurchase program. And it's worth noting, they already approved $500 million in buybacks at the start of the year, and they've actually completed about $400 million of that already. And it's vital to remember that this huge margin expansion isn't completely reliant on just one piece of tech. Their growth vectors are super diversified. For instance, they're anticipating roughly $100 million in revenue from low Earth orbit satellite communications by 2025. They also remain a highly trusted foundry for the U.S. Department of Defense, securing those lucrative aerospace and defense contracts. And looking just a bit further out, they're aiming to be the quantum foundry of choice, having recently snagged a $375 million CHIPS Act R&D grant to develop quantum process design kits. So that brings us to the final thought I want to leave you with today. As the sheer costs of developing 2 and 3 nanometer chips skyrocket into the tens of billions of dollars, we really have to ask, will GlobalFoundries' strategic pivot, stepping away from the bleeding-edge nanometer race to just completely dominate high-margin specialty nodes, will that become the ultimate blueprint for the rest of the semiconductor industry? It's a fascinating question, and honestly, it makes this company a vital piece of the global tech ecosystem to watch. Thank you so much for joining me for this explainer. I hope you found this breakdown as fascinating as I did.